Give it up for Christian and Anne. It was really appreciated. Thanks for moderating, Christian. Now, it's my great pleasure to introduce the last keynote of Deutsche Goldmesse. It's Francis Hunt. He's more known as the market sniper. I love chatting with Francis. He's got fantastic insights. He's a straight talker. There's no BS. There's no fluff. And I think he's going to woo you and really give you a great understanding of where we're at in the cycle and what is going to happen next. I've had the great pleasure of interviewing many times. We've met last in Florida last summer. And I'm really excited that he's here to share his insight with you. Feel free to ask questions towards the end. I think we'll have a couple minutes to do that. But I'm excited to have Francis here. Francis, thank you so much for coming. All the way from Cyprus this time, I think. So thank you so much.
Hey, how you doing?
Have fun.
Yeah, thank you. Technical people, can you help me? I just thought I'd bring a laptop up for some freestyle charts as well. That's it. So how are you all doing? Got the graveyard shift. I don't know what to make of that, actually. Kai said, no, it's to finish with a bang. I just think he was being polite. But I'm also aware that I'm standing in between you and the pub. And so I'm going to make it lively, exciting, hopefully, and tell you where I'm at. Ironically, this is a gold conference, but you'll probably find that a lot of the charts I'm going to be showing you are all not on the gold, but have real repercussions to the gold. So is that the one? Get that guy up. There we go. Great. It looks like we have a slide presentation as well. I'm not always a big fan of those. I prefer to talk to people. But what do we do? Well, I'm known for macro charting, which means we look at the big picture. What is the price behavior telling us? And we have a unique methodology called HVF methodology. I might mention it every now and then. But it's how we get to conclusions before the rest of the market. And there's not that many macro chartists, actually, I've found, on the big time frames. And there's not people that put their head out that often and say silly things. But we have a habit of doing that, and occasionally we get them right. So we are known for calling the Euro-Swiss franc crisis in 2009 before there was the pigs. Telling the world that for the first time in 35 years, oil will trade in single digits. We did that all using macro charting. And more recently, in 2020, September, we said it's the end for the debt market bull environment. And the presentation that you're probably seeing somewhere with the PowerPoint is pointing to the positioning for the death of a hegemon. So it's a little bit high drama. I like a little bit of drama, but it's not fake drama. It's not to get likes or attention. There is real serious things going on. And I'll tie this into where it comes into gold later, but you have to take a journey with me into the world of the great debt markets. And we are talking about the right sizing of America specifically, but also potentially the larger Western world. And so that's quite a statement to make. And you'll probably understand from that that there's going to be repercussions everywhere in terms of reserve assets. So who should be watching? Well, it's quite simple. Investors, retirees, asset accumulation people, entrepreneurs. If we get these macro trends right, which we believe we have, you know how to position for success. And we hope to be able to contribute towards exactly that. Couple of simple basics before I talk about debt markets. People don't like debt markets. Everyone understands Coca-Cola, Apple, there's a product, there's something. But we need to understand debt markets, and it's intentionally kept a little bit mysterious. In other words, they don't want you necessarily to know it. They want you to think it's boring. So this is a slightly chunkier chap with a lighter chap on a seesaw. And what you need to understand from that is when the rates go up, it actually means that valuation of the debt is going down. It's an inverse relationship on bonds. Many will know this. I'm sorry if I'm just making sure everyone in the room is with us, but rates up, valuation down on the debt markets. This is the American debt markets that I'm showing. Normally, when rates go up, actually that currency goes up as well. Why? A greater dividend is being paid. So if you're a master treasury of Microsoft and you're getting profits in euros and yen and dollars, you can decide to put more of that money in the dollars if they're getting a higher yield. It's probably understandable if you think about it, and it's an important thing. Now, when you have a debt crisis, which is my primary scenario that I'm talking to you all about, you are facing a global Western debt crisis of epic scale that is going to be economic case history, never the size of which seen before. Okay? So I am being a drama queen right now, but I think it's justified, so stay with me. How do you devalue that? You get the debt devaluation that happened since our call in September 2020, where we shorted the TLT, which is long-term ETF of American debt. It's fallen 50%. The debt markets in that short time, and we always talk about a 40-year bull market. That bull market ended. It is the funding mechanism of the hegemon of America. It's always been. All those QEs, the CV19, all of that was done on that overdraft, that unique privilege they have. And our story and our case is they have that access to that overdraft no more. The black Amex card has been taken and an ordinary credit card has been handed to them with a very tight limit. How do you deflate a debt Ponzi? You have the debt actually devalue, which we've already had for 4 or 5 years. The dollar was relatively strong during that period. And then you get the basis of measurement, the dollar itself, to devalue, which you've had more recently with the dollar. It's kind of a left foot, right foot. Don't worry, we'll be bringing this to gold, but you've got to bear with me. I'm taking you on a long and winding journey through the development of a hegemon. So this is the US government 10-year yield. And the call we made was in that blue box area. I've log scaled it. Why? Because we're talking about a 40-year time period. Log scale's good on charts when you're talking long duration. That's why we do it. And you will see in percentage terms, you get ever more sensitive, and that's a major capitulation. So that was yields going down. Bear in mind, yields going down, the value of the bonds going up. That inverse relationship I explained on the seesaw. So bonds continue to gain capitally, not as much as equities. That's why they're the 40 in the 60-40 portfolio. But you also got a small yield, and they took out some of the volatility. In the bad equity years, there's this binary system, and suddenly the money goes from the scared equity holders back into the bonds, and you had less drawdown. That was the foundation of the 60-40 portfolio, which in my opinion no longer exists as a plausible investment strategy. That big capitulation in the bottom is typically how bear markets end and bull markets end. So that obviously was a bear market on the yields, a bull market in valuation. You have a blow off top. You know it from the NASDAQ. The same technical rules applied to all primary assets, okay? But people don't apply them and they're not looking at bond charts. That's why. That was the trade. We were actually in the blue circle short. That was the earliest I know. And I can tell you that now we have the likes of Stanley Druckenmiller, Paul Tudor Jones, actively American investors, heroes, icons, master traders, declaring their position November last year. Probably they were putting it on during the course of 2024, chronically, heavily short the American debt market. So that was an interesting chart of the trade. That was the correction. A little bit of drama there, the avalanche. Bonds, remember, people, were stability. Equity was alpha. The performance was the equity. Bond was stability. Do you believe that it is serving a purpose when it loses 50% in that short time duration? Is it now a stabilizer? Stabilizer no more, and also never provides the upside of equity. So you had the worst performance for 60-40 portfolios in the last 2 years. There was a microcosm event that some of you might remember. It was the death of the political career of Liz Truss and a gentleman, Kwasi Kwarteng, not to be confused with the Kwasi that was here presenting today. He was the chancellor at the same time, and they did a stimulatory budget. That meant that they were going to add a little bit more to the debt than is expected, but they would give tax cuts, they would stimulate economic activity. It's actually what Britain needed. What ended up happening? The bond market said no. The major pension couldn't sell to make pension payments, otherwise it would have collapsed the debt market, and I'm going to come back to that point in a bit. And they had to call for help, and the Chancellor and the Bank of England came in to provide the liquidity so the pension payments could be made by a major pension. My friends, that's a serious crisis. The diagram shows you the seesaw broke. That was a key point where everything about Britain was an act of no faith. Not only did you get rates go up on the debt markets, the pound collapsed. We said when that happened in September 2022 that the same day will come soon for America where you will get a microcosm flash of such an event. And first it will come short and it'll just give you a little flicker. It's like looking behind the curtain and a little snap a peek, and then it's pulled back closed. But slowly, slowly, as you get deeper into this crisis, the curtain gets pulled back more and more. We are talking about debt. We are talking about a Western collapse. So what happened when that happened in the UK? Well, a couple of charts for you. The 10-year yield, where are we showing it? It's on the screens there. You can see the yield went up, and when you look at the pound collapsed. So you are paying more interest, and nobody wanted to hold your currency. This is called a loss of faith in debt instrument and the entire nation, which had a knock-on effect on the currency. This was a microcosm. This is what I'm saying is you see a small little event that is sigmatic or symbolic of a far larger malaise on a much broader scale that you will see more of later on a grander scale. There's our two gents that have gone short, the articles. By the way, for those of you, we're in Germany now. Germany plans to spend on military. Why has that been? And why did all this talk about how much America is spending on its military and all of this suddenly come about? Why did we get Elon and Doggy, this pantomime that we've been put through all of a sudden? Because they don't have the access to use credit anymore. The credit cards being cut up. So suddenly they're talking bankruptcy, Elon that was. Suddenly they're talking about right sizing. There was a defense minister who said, if you're not frontline, your job is under question in the military of the United States of America. This is a military force that at one point, I think they had about 32 people in staff for every one frontline soldier. So all of these things suddenly became important. Suddenly cutting and austerity in America became a thing. Why was it? Debt-based collapse. They do not have the ability to raise the debt that they once had before. It turned as a result of CV19 and the events of 2020. You also see the NATO expenditure. This is why they showed up. This is why they sent Vance to be rude to Europeans and Germans and say, you're not doing your bit, you must pay, because they can't anymore. It's not because they don't want to. They loved it when they had the power. When it was on their bill, they loved being able to determine and run NATO. But they don't have that overdraft facility anymore. That's why they need you to spend. And we'll be coming back to Germany and spending and the rest of the European nations. So we had the Trump tariff tantrum. And this was the first flash of what happened in the UK that we warned was coming for America on a far bigger scale. What happened? Of course, he pushed his luck. He went isolationist. He was attacking Europe. He was attacking China. He was being bolshy and aggressive. Why? Because he's in scavenge mode for revenue. He needs the money. And they don't have an overdraft. It was a cash chase. How far can he go? How bolshy can he be? Who can he bully for better deals to bring in income? What ended up happening, and by the way, those show you the long-term trends. Since 1913 to 2024, 97% of the buying power of the dollar is lost. But it's been slow. It's been frog burn style. It's been the slow cooking of the frog. You haven't noticed it. 2024, from 20 to 24, on the bond side alone, in a simple 4 years, you're down 45%. This is already a contraction, friends, in terms of the system. What happened on the US 10-year yield? You had the run-ups that you've been shown there. That's on the 10-year, a standard, a benchmark for US debt. You had a major run-up on the yield, and actually the euro USD went up. That means dollar down at the same time. So that same event that we highlighted in 2022 now happened in America. The dollar sold off at the same time as yields were getting more attractive. That should have seen the dollar receive inbound money. What is this telling you? Loss of faith in America. Loss of faith in America. They quickly stepped down from that, but you've seen the flash behind the curtain, and there is more of that to come. By the way, let's bring in gold into this. Because you want to know if they're taking the money out, they're selling the treasuries, they're selling the dollar, and they're moving out of America, where is the capital flow going to? At the end of the day, we want to stand in front of a tsunami and ride and surf it to the moon. And quite clearly, here you have exactly what happened. Gold rushed up. And by the way, the percentages, I put them in orange for gold, 18.4 and 18.9 on the yield. It's quite interesting that they were almost symmetrical, possibly a fluke. I'm not saying much on that. But the gold price rallied 18% in a very short time frame. I think I put that on a 4-hour or a 12-hour maybe. It might even be less than the typical daily chart, just to show you that key moment. That was not very comfortable for America. So where do they stand today? We're standing in the room and we're making a prediction to you all about the US 10-year benchmark future yields. Everyone is anticipating a massive series of cuts because they think that the Fed sets the rates. And I'm here to tell you, at the extreme ends, the market sets the rates and they've already spoken, they say no. That's why Powell hasn't done any fabulous cuts so far. That's why he's so boxed in. That's why you had the Trump-Powell tantrum as well. Some of you might have saw the histrionics and going to get him fired, forgetting that the Fed is actually a private institution and the shareholders are all the primary dealer banks, and he has absolutely no jurisdiction over a CEO of a private company. Our prediction right here, and we've been consistently accurate. We get many things wrong, by the way, so I don't want to sound like I'm talking out of ego. Plenty things wrong. But on the interest rates, we've called it once, and it was right. It was an end of a 40-year trend, and we're telling you rates go higher. Now, that doesn't mean in the next day or the week they can't go a little bit lower. We are showing you a squeezing pattern, which is our favorite pattern. HVF Method traders in our community, we look for these all the time, a volatility constriction, and then a continuation move that is high momentum with short, small risk and expansive reward. It's called high reward, low risk trading. That's what we do. It's what we specialize. This is one of my favorite setups. If anyone's looked at more of these than me, they must be Methuselah years old, because this is all I do for myself, for my community. That points to a target of around 6.3% on the US 10-year, currently trading in and around 4.5%. By the way, news flash, late on Friday. Anybody know? Downgrade in debt by Moody's from AAA. It is no longer the same quality investment grade as other debt nations. America is in the second tier now, people. It's coming. This is humiliating. I have American friends, by the way. This is not an attack on American people. This is a fact of the way that they've managed the system, the people at the top. This is a beginning of a major debt-based collapse, and America is going to be right at the forefront of it. By the way, so that we don't leave our British friends, I carry a British passport, by the way, and I'm sure the Germans enjoy a little bit of giving it to the Brits. They're looking at 5.8% on their markets, one of the most expensive property markets in the larger European conglomeration. One of the key considerations, beautiful people to bear in mind, property markets in lieu of the long end of debt going higher across the board. The affordability of property is a thing. It's going to turn violently. It's going to be aggressive. By the way, in America already, 41% of home-based lending is being declined. 41. That's not a long way off every second one. In other words, people that need to refinance, that will become a forced seller if they don't get finance. 36% on their subprime auto loan books are being refused. The finance is not coming. Think about why banks suddenly stop lending. Because the asset they are creating, remember securitization, somebody else owns that, buys it, receives the flow, is not in demand anymore. You were a biggest creator of debt instruments for pension funds in every single form of people who had lump sums that needed annuities, and now we're drowning in them. I joke about pink Crocs. I don't think them particularly fashionable. I talk about oil tankers bringing these items over at $50, and then everyone who wants to own a pair of pink Crocs has them, and they keep coming, and they keep coming, and then you open your cupboard, and there's just pairs of them falling on top of you. You go into the bathroom, and they've been stacked over there. This is an over-proliferation of a no longer desired product who's missed its fashion peak point, and you can't stop them from showing up. You'll pay to have them taken away. That is where we're going with debt as an instrument, as an asset class. Britain to go through 5.8%. Think about, bear in mind lender mortgages margins, by the way, because the British won't be paying. It's currently at about 4.5. Bear in mind they don't pay that. The bank makes a margin. They probably pay about 5.5. Maybe the slightly riskier, younger category will be close to 6. Think about what that becomes when the actual rate is 6 and the margins are put on, and then factor in the higher default that will be going on, the inaffordability and the loss in equity, how much appetite banks will have. And when they have loss of appetite, they make it even more expensive to chase customers away. So think about all of that when you think about the homeowners in these various countries. This is Australia. Australia skipped the GFC because they had China on their doorstep buying all their ore during the 09, 10, 11, 12 crisis that we're all so familiar with, subprime. Australians are going to be looking north of 6%. They haven't had those interest rates in absolute decades, and they haven't had a meaningful correction. This is going to be devastating for Australia. We're talking about Western nations in every sense. I bring in Japan here, officially allied with the Western nation, not probably a Western nation, a Far Eastern nation. This is the Japanese 10-year yield. We drew this pattern. That's an example of a scratchy HVF that we drew. We called for 1.6 when it traded at 0.2. Everybody's got used to Japanese debt being barely over 0 for decades. And they think hypernormalization, it remains that way. I'm here to tell you, we've called the first one before that. It made its target to make 0.5 when it was actually negative. And this one is at 1.6 and very close to making its target. And that is Japan. And how many of you know that the 30-year Japanese, people don't look at bonds. I understand that. They're kind of boring to many people. The 30-year Japanese rate is already at 2.95%. Already at 2.9. You think everything's close to 0 for Japanese. You're talking barely under 3 on the 30-year Japanese rate. And by the way, the target for that is 6.3. That's European, British level plus rates. What happens in those countries if rates meet these levels we have been calling, and it's not the first time? So what about France? We're getting close, Germany. You should start sweating. We're dealing with the French now. Your time is coming. The 10-year, again, weekly chart, 4.6%, and you've got to bear in mind it's been in the 2.5–3% range. Think of the percentage climb to go to 4.6% when you've been averaging 2.5% and 3%. Think of what people are going to play. Now, the French aren't the most over-leveraged to property, but there's been some sketchy investment in every European nation, I assure you. Time for Germany. Your 10-year DE, 10-year target is 4%, and you've been used to low 2s and 2.5% in the recent years. 4% is an 80% increase in payments, friends. And they're going to want to lend less to you. And you have Deutsche Bank, Commerzbank, some of the most crippled banks, already known to be crippled. So what do you think that's going to do to the speculative housing market in Germany? This is, I told you it was the graveyard shift. This is doomer talk. The Grim Reaper is in the house here, and he's telling you scary things. So that brings us all the way, circle back to gold. And many people are sitting here, and people, I'm afraid I disagree with projections, and many people, even gold bugs, they don't. Nobody seems to understand, or I'm in a delusion. You can decide for yourself which one it is. The scale of the debt-based crisis is unparalleled in any economic history that we've ever had. We're as globally connected as we've ever been. We've never been this connected and interreliant on each other as nations. And the entire Western nation, I left Canada out, but trust me, it's the same. I left New Zealand out. You know, I didn't do the Dutch. It's all the same. Trust me, I'm a geek. I've looked at them all. They're all a mess, and they're all going higher by potentially up to 80%. What does that lead to? It leads to the reserve asset of debt no longer being seen for the fraud it always was, of overproliferation, overlending, governments overspending, the currency destruction in every nation in a synchronized manner that sees us all living like lepers in a leper colony where you've got to kiss the chief, filthiest leper to join the colony. That is the Western world right here, right now, in terms of debt. There isn't a sound money advocate or politician to offer me a nation to run to in the world right now. That's where you stand. So, for those that are saying gold is topping, I'm saying the very first smallest part of the breakout is having its first micro rest, which is going to turn out insignificant on one of the biggest moves you've yet to see that will be historic and will even shame the 80s rally. That's how big a bull I am on the last man standing in the room while everyone else picks up the revolver and eliminates themselves. It's gold. It's still gold, it will be gold, and you will hold it. By the way, in terms of HVF method, I'm going to leave this on the chart here up a little bit. We have what's called interim targets. Interim targets is where we expect a rest. And you'll see there's two here. It's very faint, the very first one. I'm just looking at the screen. You might see a dotted purple line at the base of the blue box that runs all the way across, and you'll see 9.91. By the way, I haven't been clear on this gold chart. It's divided by the CPI AUCSL. You're going, what? What's that? It is the consumer price index for all urban costs in America. It's a BLS number. I say you could probably cut it to just a BS number. But anyway, that's just my cynicism towards stats in America. But it's a guide. It's what they want to throw out. We'll take them at face value. I don't believe him for a minute, but hey, we're adjusting gold for the American alleged inflation. I'll leave it as alleged inflation. That technical setup has barely got out of bed. You're at our first interim. You're having a small, tiny, whiny little shooting star. You may have a pullback. These numbers on the side won't mean anything to you because you're dividing by something which is an index. But essentially you're at 9.9, and our target sees a number of 52. So just understand the multiple to get from 9.9 to 52. There's something very interesting about HVF method in how we trade that I'll tell you as well as a secret. We teach this in our program, but I'll tell you this for free. There's a dashed line as well, and that's our second interim, and it comes from the geometry of the second impulse. That's quite soon. It comes at about 12. And then the gap between the dashed line and the solid line that you're looking at. Now, there's the bit where all the gold investors can't stop smiling. Now, I'm afraid it's going to be a terrible world for the rest of the people. And you've got to bear that in mind, and you've got to take certain security matters into heart, because it's something that nobody's seen coming on the scale that it's coming. But you, as a gold investor, are going to have the near parabolic run that will defy most people's belief. That is what's coming for gold in due course. And you only have to sit and be patient and not buy any of the top callers that look at the small time frame charts. In a macro trade, you trade the big time frame charts, you have an agreed entry, an agreed stop, and an agreed take profit, and you cling on for dear life the whole way through, and you stack like you're a thief. I buy 75% gold and 25% silver, only because I fear unobtainium later on silver. There's another point of difference to me and all the other precious metal bulls. The scale of this crisis will be so large that it is not impossible. Note the phrase, I'm not saying it's going to happen. It's not impossible that despite us churning at the 100 level gold to silver ratio, that the collapse that will come will see gold, the primary reserve assets of the kings, and when the bastards that did all this to us are hiding their money, they're not running to silver. They're running to gold, and that's the big money. If you want to know what the big money is doing, it wasn't even buying Bitcoin. There's a little bit, for sure, but the real big money has gone into gold. They've already shown you that. Never forget that. keep stacking the gold. We will trade the breakdown of the gold-silver ratio and rotate into it once we've had a very clear topping on a big time frame, and we could be far away from that. When the scale of this crisis comes and debt is collapsing, the big money has shown gold. Ray Dalio bought 315 million of GLD, not of Bitcoin. He's the one who also speaks closest to us in terms of contagion, debt-based collapse, and the end of empire, with some drama too. I'd say maybe listen to him. I've never heard Warren Buffett ever be more bearish. This is Captain America. You won the lottery being born in America, he told you, to all Americans. This is a man who has a flag waving behind his head every time he speaks. It is a stars and stripes flag. He's never been a bigger pro-American man. He's choosing to stand down. He's going to live to 140 as far as I'm concerned. He could continue for another 4 or 5 years, no doubt. But he's putting a new man in charge, and he's going international, and he's making comments about his recent concerns about the dollar, the sustainability of its valuation, the trade deficit that America run, which hit records recently, before they stopped all trade with the tariff tantrum. Fancy that. There's a lot of monkey business going on trying to avert a key crisis that is staring everyone in the face, and people are sleepwalking while we are witnessing this. This is the biggest debt-based collapse in economic history. Okay, so some final conclusions, and then I'll freestyle on some charts for you if you want to ask me any questions and show you anything. So 2020, September, was the turn of a 40-year bull market in debt. It means everything. It was pitched as a key reserve asset. It means it's now shot itself through the head. The final man in the room, but the gold man, is dead. Only Midas man stands in a world where all the money now has to find a place to move. The scale is bigger than you think it is. U.S. has had its credit card pulled. I've said that enough times. The death of 60-40 portfolios. People forget it used to be 10% gold. That was your fire insurance. And 20 and larger sums. And there's Italian wealth that has 33 1/3 property, 33 1/3 gold, 33 1/3 equity. People have forgotten. They got coerced. They got encouraged by the likes of Greenspan, who spoke one way before becoming a Fed and then another way since becoming a Fed. Probably the biggest economic criminal ever to exist, that pushed liquidity, and asset booms. And believe you me, there's a bust, and we haven't yet once ridden a full bust to the downside. They've always come to the rescue with more poison. And eventually, they've lost the ability to issue that any further. Financial repression awaits you. Financial repression means essentially policies of eroding something down by active intent and degree. That is what happened in the 70s in the debt markets when Volcker pushed the rates right the way up into the 80s. Now, every nation in the West has to go through a process like that simultaneously globally. Think about what that means by scale, and then tell me I'm a drama queen. Fine, end of the uni-state power, multipolar words. A lot of you will get this. This is geopolitical repercussions. The Western government is probably going to invoke further, I call this scavenge mode. The desperation for revenue for governments to maintain existing spending plans is going to go off the hook. Don't be the last to leave, you'll face an exit tax. That's all I'm saying. Unrealized capital gains, it's going to become a thing. Tax for this, tax for that. It's starting in the UK under Starmer, which is a left-wing socialist government. They're running out of money. They're chasing their wealthy people away. Those policies, it's a controlled demolition. It ends in financial failure. The wrong people are in charge with the wrong policies at the absolute worst time. There's only one outcome. There's only one outcome. Western housing markets to correct. Some should consider leaving their countries. That's not a popular statement that I make. Everybody hates me when I say that. Well, I got children, I got this. You can't tell me to leave. I'm not telling you anything. You do whatever you want. But you can sit in America as a Gen X or a Gen Z and pay for boomers that have all retired and have multiple bubbles to chase up their wealth. And you can have 8 pensioners to support where previously there were 8 citizens supporting 1 pensioner. and you can have the government tax you into the ground, and you can have everything that goes with a dollar collapse and a debt-based collapse and a deflation of industry, your housing market, your equity market. So everyone will ask, what about equities? I say the primary thing is bonds and gold right now. That's the game. But in truth, if we get the full financial leveraging, the equity markets will go down. They will go down hard, and they'll go down for a long time, particularly in America. To the other nations' benefits, actually, there are equity markets we see going up. We cover that in our community. So what else have I got for you? Germans should resist the end of cash. By the way, I was going to put a slide in that showed a recent event in Spain. 3,000 euros being drawn, 24 hours notice, clearance from your tax authority, else 150,000 euro fine. Cash, your anonymous money, your last anonymous money, where I can pay you and you can pay me, and it's no one else's business between us, and this is where you go. And you tell me that's your money in the bank? None of what's in a bank right now is truly yours. I'm here to tell you that, and go watch The Great Taking. It can get worse for you. So let's finish on how you position on the macro for gold. Ongoing, the pullbacks will be small, the moves will be fast. This is multi-generational, it's huge. Look at the big time frame charts. Dollars could have a spike on an interest rate surge. It's an unhealthy spike. It'll be a once-off event. It's possible. Doesn't have to happen. Everyone gets super doomer. Then all the emerging market debt has to get paid off. They have a collapse in their debt market. Their rates could spike so high. But that would be what I call a sugar rush spike. It's not a healthy economy spike. It could be a detail of a collapse. Emerging and other offshore dollar-denominated debt could have a collapse if they can't make the payments. We're going to have high FX volatility as a result of this. Debt-based collapse is FX. Money is borrowed into existence. We had the collapse of the debt, then we had the collapse of the dollar. Eventually, the steps start to run so fast, they end up coinciding. You will lose buying power in all your fiats as the debt markets go. Germany is preparing to start spending more. Your interest rates will reset higher, and your money will be devalued. I prefer, if you have to get outside of gold, and I really don't think there's much else, sometimes it's that simple. It's a uni trade. There's a one trade in the house. But take softs over energies. People get excited about the commodity, overall. The devaluation of money means all commodities up. The consumer is going to be destroyed. No more Amazon, no more packages, no more holidays, no more driving the car, or much less, no more anything. That is not great for energies. By the way, Saudi announced an output increase in what is essentially a recessionary environment, potentially going to turn bad. Why would they do that? They will be compensated in other ways. They are receiving Elon Musk's investment on Neuralink for putting charts. They want a technology existence. They're becoming the bread and circus for the citizens, the U.S.A, the football, the highest football players. I'll tell you a boring aspect. I'm a rugby fan. And the next World Cup won't be in South Africa. We've won it 4 times. It's going to be in the desert with Arabs who never play the game. Just like Formula One, just like everything else. There is a pivot to the Middle East and also to Singapore. It is going to be a slow drain of the tech and the competence of America. America is going to be right-sized, I'm afraid. I say it with some sadness, not with any glee. We do play very small in the crypto space. We don't trust them. But we know certain things are coming, whether we like it or not, and it's the status tokens. And we have technical backing for our views. If you want to know more of that, I'm not going to get into this here in a gold conference, but you're welcome to chat to me afterwards or get in touch. The incoming trend, Dubai, Qatar, Emirates, Singapore, for location of money. Watch it on the equities. With the downgrading of the total market cap that we foresee of the huge market cap of American equities, there will actually be equity upside in spite of all of this on the basis of fiat devaluation and some of the skills and the investment and the capital formation moving away from America. That is it. I hope that was interesting for you. I remind you of one final thing, the Hegelian dialectic. Centralization of power is the thing we should all be fearing right now. It says manufactured terrorist threat. That's a financial threat as well. Power outages, various other things. Regressive police state. I'm seeing it in every major Western world. We are facing a repressive police state. It is not your money anymore in the banks. The banks are spies that work with the state actively against you to disempower you from making your own financial freedom and being self-reliant. Synthesis, remove all freedoms. That's what they seek. Okay, that's us. We're the Market Sniper. One more final thing. We're here to help you build wealth in reset times. We're here to help you sustain and keep your wealth, which is a far bigger, longer-term challenge, and secure personal freedoms. And I'm afraid the West isn't the place for it right now. Okay, thank you. Would you like me to do any charts?
I think we can spare 5 minutes to do some charts.
Yep.
Francis, if you want to. Like, what chart should we look at? Francis is taking requests.
Sure.
Coming right up.
So a lot of people on the miners. So I'm going to give you some advice on my take, because the request for GDX, I'm forward guessing why you're interested in that, okay? I understand gold and all of that. Here's the key thing. People are getting ahead of the curve on how we should be trading this. The best trade has been gold so far, the metal. And the thing with inflation and the devaluation of money is it creeps into costs too. So even though metal go up, costs go up. Metal go up, good for me, I hold the metal. Metal go up, kind of good for you, but only if it's going up much faster than costs go up. That's why miners have lagged. And of course, dilution, lack of liquidity, lack of focus, and we need the world to first wake up. It's coming. I'm not saying it's not happening. It's coming. It's begun some bottoming. But the truth of the matter is, if you had all your money in gold, you'd be doing far better. People ask me, how much? So just building further on your question, should you have just in the metal? And I say, you can still buy online insurance for your already a light home. Are you buying 1%, 5%, 10%, or maybe are you going to go to 50 and 100 and maybe a little more and get a better home? They're still selling the fire insurance. But I'm telling you, the fire started long ago. And it's getting to the geyser, and there's going to be a detonation soon. That's when the online guys suddenly work it out and they stop offering you fire insurance, and you go no bid. So that's why gold first, wait for silver, wait a little more for miners. Everybody thinks they need to be in everything. Mono, singular path, metals for now. The gold metal, king. That's for me. So yes, it's recovering, but you've left a lot of money on the table in terms of gold's performance generally. I'll show you something else on the comment I made on gold versus the other commodity in US oil, for example, which is WTI contract. Let me just show you this. This will just show you that not all commodities are equal. Remember this, people put gold as a commodity in the same pot as oil. You're talking about a consumer lubricant that we need and use for activity. When economies contract, they use less, and you're talking about a reserve asset. There's nothing remotely the same. The fact that they get put under commodity labels is absolute foolhardiness for me. You're talking about reserve asset status in a collapsing fiat system. The only one, unless you're buying digital scarcity really hard, which personally, if it's been made by the NSA, I'm not trusting it. So let's just get that, sorry, one more time on the chart. Fooling around a bit here. By the way, we made this call in COVID. That was a reversal call. I'm going to just show you this as well. It's good. It's a fun chart. That super spike was the collapse of oil, obviously to a very, very low level. And there was an inverted head and shoulder on that. I'm going to just try and get sense. And more recently, we've had the exact same setup. There is similarities to the COVID event, I would argue, that are coming our way. This reversal in gold divided by oil. You can see, and this is log scale. So that was 13 barrels. An ounce bought you 13 barrels. Think of them standing there, big greasy stuff, 13 of them, and now you get 60. That's the cost of being in other energy-based commodities. Some guys like uranium. I'm like, gold's better. It's energy. Yes, uranium will come back. Yes, it will make up a bigger percentage. Of the energies, it's the least bad, but nothing beats the reserve asset right now. Any other requests while we're up?
Don't be shy.
So the oil gold is a typical long short that we do. We have some on equity indices, but I don't think that's appropriate specifically. I think you're thinking within the precious metals space. You could look at stocks, high-valued, high PE stocks, particularly in the tech space, maybe, against miners with proven supply and bringing. I would look at that technically, so I don't have anything off the cuff for you, but those are areas that I would see some deflation in at some point.
Fantastic. Francis?
Great.
Oh, Claude, obviously.
So we have upside setups, funny enough, in emerging markets and Singapore, the STI Straits Index. We have a macro, major upside setup. Some people have shown some pretty interesting basing on the Brazilian Bovespa as well. So that's kind of soft commodity play and a lot of other things. And we are outside of gold. We're in a very nice paying cocoa trade at the moment to the upside on devaluation. So coffees and cocos are particularly tasty for us. And they've got big macro setups. And so that rhymes a bit with the Brazil Bovespa type index. So I think you see that emerging flow, and I think you see a drain away from the US. But they're going to scramble to get into mining, and they're going to run into Canada and all of that. So Canadian equities could do quite well. We've got a lot here during this period, especially if they're involved in gold. And I don't even think the guys that were here today are as bullish gold as I am. So those ounces in the ground are going to turn into big, big babies. They're gooses that are laying massive eggs.
Wonderful.
Great. Thank you very much.
Do you need this, Francis? No, I'm good. Well, I don't think I promised too much. Did we save the best for last? Well, it's close to it. So really enjoyed Francis's presentation. Please, just give it up for him again. I really appreciate it. Francis, thank you so much. All right. I'll get you clapping a couple more times because we got to say thanks to the team here. Have done a wonderful job. I hope everybody had a wonderful time here over the last 2 days. I can't believe it's over yet again. I say it every time. It just goes by so fast. I'll never do 3 days, by the way. It's just too much. But 2 is great. Show of hands. I actually have a question. Thursday or Friday and Saturday? What did you guys like better? Thursday and Friday? Show of hands. Friday, Saturday? Oh. There we go. Well, I shouldn't ask on a Saturday, I guess. I'll ask again next time on a Friday to get a more even balance here. No, really appreciate everybody coming. This is the end of Deutsche Goldmesse. All the presentations will be uploaded to our YouTube channel. If you missed it, we're not sending around the PowerPoint per se, but you can find it online. We will put it up on our YouTube channel. So you can stop, screenshot it, and use it at your leisure. That's it, I think. Save the date, November 14th and 15th. We moved it up a week. Make sure you come to the new venue, JW Marriott. It's not actually new. We're going back to the old. It's the OG venue. We've been there. That's where we started in November 2021, where we hosted our first event. So make sure to come there. Sign up in time. Maybe a question or an ask. Please do sign up before the event. We've had a couple walk-ins. It makes planning a little more difficult. If you know you will be attending, sign up as early as possible. It just makes planning a lot easier. So we do appreciate that. And thank you so much for coming. Have a safe trip home. By the way, Frankfurt made it into the Champions League. They're up 3-1, so I hope I didn't spoil it for anybody. And Dortmund made it as well. And I wish everybody a wonderful weekend. Thank you so much for coming. Have a great day.